This is the third of three videos about accounting for long-term contracts using the percentage of completion method. In this video, we are assuming that we begin the contract expecting a profit, but cost overruns occur or are expected to occur at some time during the contract, but before the end of the contract. And let's take a look. The facts are the same as in the other videos, except that we have the contract price of $450,000. Therefore, when we have $100,000 in year one and expect another $300,000 to occur over the life of the contract, we're 1/4 complete. And we use that to recognize revenue for the first year. 1/4 of the total contract price is going to be recognized as revenue. And that's what we do here. We take the $450,000 contract price times 0.25, and we have year one revenue that's recognized $112,500. And then we show the costs incurred in year one of $100,000. We record year one gross profit $12,500. But things change in year two, and that's where we're going now. In year two, we have the total contract price is still $450,000, but we've incurred $300,000 by the end of year two, and we still expect another $200,000 of cost in order to complete this contract. So in terms of the amount that we're complete on the contract, we take the 300 divided by the total of the 300 and the estimated cost to complete, or 500. 3 over 5 is 0.6. So we take 0.6 times the contract price, and we have $270,000 of profit that needs to be recognized by the end of year two. We subtract from that $270,000 what we recognized as revenue in year one, which was the $112,500. Gives us the additional revenue that needs to be recognized, $157,500. And we subtract the cost incurred in year two. That was the difference between the 300 and the 100. And that's $200,000. And we have a year two gross profit, which is actually a gross loss of $42,500. But wait. Is the overall contract now expected to have a loss? And the answer then is yes, because our total expected costs are $300,000 that we've already incurred, plus another $200,000 that we expect, $500,000, and the contract price is $450,000. So we're expecting to lose on this contract, and therefore we need to recognize all of that loss by the end of year two, and that includes reversing the year one profit. So let's see it. We have an overall loss of $50,000. We have to subtract further the gross profit that was recognized in year one. And so in addition to the overall loss, since we've already recognized some profit on it, we have now to recognize the $62,500 loss in year two. We have just to recognize, to show, we have the $157,500 of revenue, but in terms of gross profit, we have a $62,500 loss that needs to be recorded in year two. We're not going to do the journal entries. All what we're going to do is show that we have the $62,500. In year three, we will have completed the total $450,000. Recall that we had $112,500 in the first year, $157,500 in the second year of revenue. We therefore need $180,000 of additional revenue to show the full amount of revenue in by the end of year three. We had shown $12,500 in year one. We booked a loss of $62,500, and our overall loss is $50,000. And that is how we would recognize revenue and gross profit over a long-term contract where cost overruns generate an expectation of an overall loss on the contract.